My guest, I'm David Ingram. We're doing this in my living room. The program is around the world, and you find it at www.david-ingram.com. And we do this every Wednesday night. But my guest tonight is Dan Walkow, www.seabankcapital.com. And if you want to get Dan other times, you're going to get him at 866-541-9952. And we were just talking about doing California tax returns and the fact that his company provides all the accounting required so that your accountant can do the reporting for a Canadian RRSP on your U.S. tax return, whether you're doing a 540 NR or a 540 or a 1040 NR or a 1040. They do that for you so that your accountant doesn't have to charge you for 10 hours of starting to try and figure out these rather complex little things.
Well, the problem is of course, as most people know, to keep track of all your statements and or contracts and so forth, wouldn't it be nice to have all that data online where you can just hit the button, calculate the capital gain loss for the account, you got the time period,
yes,
and all the relevant data, the conversion numbers and so forth, and calculate the appreciation in U.S. dollar terms. It works.
Oh, it would be so wonderful if everybody did that, but nobody
I mean, how
does
many
that.
people have come across bringing the shoe boxes? You know, we do the thing when we take on a client, say, well, you know, so do you have capital gains or losses prior? Do you want to bring in your cost basis for most of your securities so we can properly adjust them into our system? Well, the shoebox comes in, you know, and away you go, right? So, and sort of we spend a considerable amount of time inputting the correct data so we get a good starting point with a new client. But again, back to the California issue. One interesting twist that I was thinking of the other day was, what happens, David, and I think there's a benefit here if you're a California resident, what's good about cashing an RSP in when you're a resident of California?
I don't know. You're going to tell me.
It's not a taxable account.
Well, the principal isn't.
Right?
Yeah.
So there's some tax relief.
Yeah.
That you
Well,
have.
this is the other thing. When you are paying the tax as you go along, you're getting an adjusted cost base for California purposes. And then you've got to decide, well, maybe if I'm paying California anyway, maybe I should be paying and paying the federal tax so that I've increased the adjusted cost base as I go along. I don't think so, because when you do cash it in from Canada, you end up with a 25% tax, and there's nothing to claim the foreign tax credit against.
There you go.
So it's
worthy of consideration. It's an issue of when you go down. I mean, if you're going to terminate your RSPs or you terminate your Canadian retirement programs, whether you should do it before you go to California or any other state, right? I mean, I think it's a decision that should be made, and some thought should be put into pre-planning these things before you go down.
Okay.
And do you not agree?
A good argument can be made for taking the money out, paying the 25% withholding tax, and reinvesting the principal in a non-registered account, and borrowing the 25% tax that you paid to Canada, so you have the same amount of money working for you.
I know some people would say, well, but I want to keep the answer to that, David, and the hook, the problem for people has been is this. I don't want to cash my Canadian RSPs in because they're in Canadian dollars. Therefore, if I move to the States, I want to keep some of my assets in Canadian dollars. Therefore, I have to keep my RSPs because, as a new resident of the United States, I can't find somebody to provide me with. Well, I want to give you the solution, absolutely. I can't find somebody to supply me with a regular Canadian dollar account for a resident of the United States. Well, we can. So if you want to move, but you don't want to convert your money into U.S. dollars, we can collapse your RSP. You pay your 25% withholding, and if you're a high wage earner, over $150,000 or more, right? Your lowest tax rate is going to be the withholding rate on your retirement program. So we'll just take that money right out of the RSP. We put it into a regular cash account. You can buy the same stuff, generally speaking, in your Canadian cash account as you could in your RSP. So you do not have to. You
don't even have to change stocks.
No.
And you can borrow, if you want to, an amount of money to make up the 25%, so you can have the same amount of money working, and the interest that you pay out on that loan is deductible.
Right.
And on both countries. Yeah. Deductible in the States, deductible in Canada.
So there is a way, and I think up until recently, most people, and certainly newer people I talk to, ask the question, well, why didn't you cash your RSPs before you left, or reduce them, or whatever? And the answer was, often I get, is, Well, I wanted to keep it in Canadian dollars.
And of course, anybody that did that, anybody that cashed it in and took the money to the States between 2000 and 2005 lost their shirt because of exchange, and if they
exactly.
bought U.S.
The
stocks,
wisest move over the last 7 years was to keep your
the
RSP
Canadian RSP.
and keep the Canadian dollars. But the issue is not the tax issue; it's the Canadian dollar issue.
That
right?
was their
so here's a solution that you can have, where you can kind of have your cake and eat it too, if you want to think about it in that way. But there's a solution that makes a lot of sense. I guess the other side of it is, even if you were currently in the United States and wanted to cash in, pay the withholding, and so forth, for whatever reason, and have more flexibility on a taxable account basis, you can still do it.
Yes.
Right?
Well, you can, depending on what you're paying and what you're getting, it can be very much worthwhile for you to do that and use it to pay down, even though a U.S. mortgage is deductible. In many cases, you're better off because, see, again, and we forget this, that there's places all over the United States that you can buy a real heck of a house for $200,000. And $200,000 will buy you a 4-bedroom, 4-bathroom house in Cape Coral, Florida, on the water. Not $250,000. Well, anyway, so making a long story short, you might only have a 5% mortgage and $200,000 is only $10,000 a year interest, since you get $11,400 a year as a regular standard deduction anyway. To claim mortgage interest and the property taxes, you might get $12,400 or $13,000 as a deduction instead of $11,400, and it isn't worth anything to you. It's worth like $150. You would have been far better off to pay off the mortgage with your cash and not worry about an itemized deduction, because you get a better, your standard deduction is just as good.
It's fine.
Or close. Now, if you've got a $700,000 mortgage at 5%, you're paying $35,000 interest, whole different matter. But even then, you lose your $11,400 standard deduction, whereas in Canada, if I make your mortgage deductible, you get it plus your standard deduction.
Plus on top.
So it's a better deduction.
It's a great concept to make your mortgage deductible.
Oh, of course, making your mortgage deductible is the most important thing that you can do in Canada.
It's an automatic in this country.
Well, can I use this house? We're sitting in this house, and I told you about how I had to pay all this money for it. And I have a $500,000 mortgage on this house right now, and the interest is, I think it's 4%. 4% of $500,000, what, $20,000 a year interest?
Go ahead.
And this mortgage is clearly deductible because I did the expense damning. And $20,000 deductible, doesn't matter what my tax rate is, but I'm going to get either $5,000 back or I'm going to get $8,000 back. So it's only going to cost me $8,000. I'm sorry, it's going to cost me $12,000 or $15,000 to pay. Now, if it's not deductible, then I have to make a whole bunch more money. I have to be in a higher tax bracket, because now I got to make $35,000 and pay $15,000 tax.
It's a technique that everybody should consider.
To have $20,000 left over. But I'm self-employed, as you are. For me to have $35,000 left over, I've got to do literally $80,000 to $100,000 worth of business, pay $35,000 worth of wages and $20,000 worth of expenses, to have $35,000 left, to pay tax of $15,000, have $20,000 to pay the mortgage. If I can pay the mortgage of $15,000, instead, I only got to make about $35,000 instead of $100,000.
Let's talk about California residents moving back to Canada.
California residents moving back to Canada.
In California.
Okay. If we're going to do that, we're changing the topic. I want to set this up so we can make it a little segment again.
We're done.